Thanks for having me here today. I'm going to give a brief overview of Bernhard Capital Partners. We're a first-time fund and really appreciate the confidence that this group has given us, and I think that we're very excited here to give a report on how we've done in the first year since the investment and a lot of the investments we've made. I'm going to give a brief overview of the firm. I'm going to talk about our strategy and how we look at the market and how we attack the market. I'm going to talk about our team and the team we've put together. We started as a very small group here in Baton Rouge, and we've grown into a larger group and people we've recruited from around the country. I'll explain who those folks are. And then I'm going to explain our execution, how we've executed upon the capital that we've been given and how we've gone out and made investments exactly according to our strategy, basically. And then finally, I'll talk a tiny bit about our performance and then talk about the general overview of the market in terms of where we see the North American market, where we see the world market. In particular, we're a services business. We're heavily focused in energy focused on the downstream, midstream, and power sector. So we don't do anything with respect to extraction of oil and gas. So a lot of people say oil field services. And as we know, with oil having been at 100, now at 50, a lot of businesses in Louisiana and around the country in the South and Houston really struggling from being purely focused on oil field services. And in the 30 years that we've been focused in investing in services businesses, we've really never focused in the oil field, and part of that reason is because it's so cyclical. So we really focus on where the extraction of the oil and gas comes out, and then it needs to get sent into a pipeline, sent to an LNG plant, sent to one of the refineries down here along the river, sent to ethylene plants, where the oil or gas is then processed. And so the downstream piece of the business and the processing piece of the business is where we focus, as well as infrastructure. So state and local infrastructure, whether it's roads, bridges, water, wastewater, is something we've always been focused on. And so we'll talk a little bit about the end about our new president and having a huge focus in the infrastructure services in terms of the infrastructure that's going to be built and the likely investment that will come in the next couple of years, and the belief that we're very well positioned to invest. And we'll talk a little bit about how we're looking already at some companies that will take advantage of the spending over the next several years. So again, call ourselves really kind of middle market, $750 million. We look at businesses that are really buy and build in a lot of ways. So we look, and I'll talk about our blueprint effort in terms of our strategy, but we look at businesses where we can invest in a segment that we like within services, and then we look at additions that we can add on. So sometimes we call it the Christmas tree approach. We go out and get the Christmas tree first, and then we start to put a couple of ornaments on where it makes sense to grow the business through a buy and build strategy. We had our final close this last year, approximately $750 million. And one of the things that we're very proud of is that it's been 3 years, so we took a year to plan what we were going to do. We took about a year and a half to raise the capital. And then the last year and a half, and really from the first investment we received from a limited partner from one of our investors, we began deploying capital. So to date, we've already deployed $500 million of equity in 5 different portfolio companies, which some believe is really pretty rapid, but I'll kind of take you through the approach, because when we first met with Bobby and Lanny, Darren, the team here, we're going to show you a slide where we came and said, look, these are 5 identified areas and strategies that we want to invest in. And we're very proud that today we've invested in 4 of those 5 and are actively looking at others. So we use, no, let me jump just real quick. That was in 17 transactions that we've done. And one of the things that we're most proud of is today, and we've been doing investments and looking at acquiring service companies for a very long period of time. And what we find is there's a lot of middle market private equity firms and a lot of private equity firms and a lot of strategic acquirers, big businesses, that basically wait around until an investment banker comes to their office and says, hey, look, here's a company we have for sale, and by the way, I got 7 other people looking for it, and in 3 weeks, I'd like you to look at this information and give me a bid on how much you're going to invest in this business and what the number is you want to buy it for. We do it a little bit differently. Why don't we go to the next slide? We use what we call our blueprint investment approach. So just like we identified the 5 companies that I'm going to show you, or the 5 investment ideas that I'm going to show you on the next page, we kind of take a step back at the market and say, okay, where's the market today? When we first started, what we recognized is that because of fracking in the United States, there's going to be an abundance of oil and gas in the U.S. We couldn't predict the price, and we didn't try to predict the price, but we know there's going to be a lot of it, a lot more than we've ever had. And so now we knew that people were going to have to do more with it. And they're going to do more with it in the United States, because if you have, as a matter of fact, Exxon's right next door. If you went into that room and said, where are you guys going to invest in the downstream and midstream, they would all say, we're going to have a North American focus. Why are you going to do that? Because it's a safe bet. It's a safe place to invest when I don't have to go to Venezuela, I don't have to go to the Middle East, I don't have to go to China, I don't have to go to India, I don't have to go to the Chinese South Sea. We have an abundance of oil and gas here. I want to process it, and even though environmental regulations are difficult for me, I'm going to do it right here. And so I think we're going to see Exxon come out, very soon with a major investment. Hopefully we still have a shot at it here in Louisiana, but I think the likelihood is what we're hearing. It's been reported in the press that it'll be in Corpus Christi, probably a $7 to $12 billion initial phase investment on an ethylene plant. So what we think about is, as that whole trend goes, how can we supply more services as there's more investment in these areas? Again, that's where we identify our specific investment opportunities based on our operational knowledge. So given that there's going to be a lot of oil and gas, how do we split out all the different ways we want to play that? There's environmental, there's maintenance, there's services, there's engineering, there's selling products, there's selling valves, there's an enormity of areas. And so we kind of put all that on a board, and we start to do some market research, and then we narrow down into the specific areas that we like and we think are going to be great areas both for us and for the companies. And then a differentiator, again, is the proprietary sourcing. After we identify, I'll give an example of industrial services. We say we really want to be industrial services. We want to be a middle market firm. Why don't you go to the next page for me? Skip, and I'll skip back. So again, going to our blueprint strategy here. These were the original 5 opportunities that we brought to investors before we'd made any investment. And if you look at the bottom, we've done 4 or 5 and executed upon those platforms. Industrial services is what I was going to talk about. So we say, okay, we know there's going to be a lot more expansion in the industrial sector, chemical plants, refineries, the midstream. How do we want to play that? Historically, when we were at the Shaw Group, we would want to build a $1 billion plant. We would want to build a $2 billion plant. We traveled to China to build ethylene plants, $4 billion. As we move forward, we recognize that there are other companies much more well-suited than we are, and it's not really the strategy that we want to make in terms of making a good return for our investors. So we say, okay, what we want to do is play the middle market of industrial services. We want to look for a maintenance company that is out in the U.S. providing maintenance to what we would call nested customers. So not necessarily the guys who are doing one Exxon plant or one Shell plant or one Chevron plant, but we were out looking for the maintenance companies that were doing maybe all of Celanese's work. So Celanese has 12 chemical plants around the country. Who is doing all DuPont's work? DuPont has 40 chemical and processing plants around the country. And so we identified Brown & Root. Brown & Root was a part of KBR. They had stopped using the name, and they had a maintenance company that provided maintenance for DuPont, Dow, and a little bit of Celanese. And they did this for all of those projects around the country. So as we thought about the strategy, what did we want to do with just providing maintenance? Well, now we want to sell other products through those contracts. So we added on an engineering company that we bought, Wink Engineering, from a publicly traded company. So now we can sell engineering and maintenance to DuPont in their 40 plants. Then we added Petrim, which is a scaffold company. So now we sell scaffold to DuPont as well in terms of their other clients that they had. Then we added a turnaround business called MEI. So they weren't providing the turnaround work. So now we can go to what we call, again, the middle market chemical companies that have large footprints around the country and provide a unique set of service offerings that's basically turnkey. Engineering, specialty services, maintenance, scaffolding, turnaround, specialty welding, which in our opinion is differentiated amongst anybody in the country in terms of really having more offerings where we can lead with design and engineering and not just provide the body. So what we're trying to do is help those guys save money at their plants. So we're bringing them new technology, new reliability, new engineering, so that when they do a turnaround, if it used to cost them $20 million, we'd rather it cost them $15 million, but we can make more profit. And so, so that just gives you an idea of how we think about kind of this blueprint strategy and then how we go execute. Obviously, the three others that we've done, you know, right in the same type of strategy of, again, coming up with the blueprint and then going out and identifying the entire marketplace, identifying the companies within those sectors, and then basically going and knocking on doors. A lot of times we're knocking on doors with friendly faces. It's people that we've done work with over a long period of time, that were either subcontractors to us, partners with us, joint ventures with us. So having been in the industry for a long period of time, there's a trust factor that comes into the conversations we have, and we'll talk about a couple of conversations where companies were actually going through a process of selling their company, had an investment banker, we're hoping to get the best price, and we basically come in and say, hey, you know, we're credible, we've worked with you for a long time. If you want more money, we'll tell you who to go talk to, because there are other investment firms that will likely pay you a higher premium, but we believe we make the best partner. We think we have the best strategy, we understand the business, we're trustworthy. If we do something, tell you we're going to do something, we're going to follow through and do it. And I think through the 17 transactions we've done just in the last 3 years, if you called any of those companies, you know, they serve as our best reference. Let's go back to the team. So I told you I was going to talk about our team. If we look here, we have a very robust team. I was telling someone the other day, I would put these guys in Baton Rouge, Louisiana up against any New York firm in our space in the middle market in the entire country, and we've gone out and visited with a lot of them and been around. So we're very proud of the organization we've put together. I think if you put up does that work? So here, many of you know we came from the Shaw Group. Jim had started the company in 1987. Grew it through a series of 20 acquisitions and investments, and you know, eventually obviously sold 3.5 years ago, and we decided to venture off into this new venture. The symbols here show the team that originally came from Shaw. So we had a core team that came from Shaw. Obviously we had a lot of investment experience from the strategic standpoint, didn't necessarily from having start and run a private equity firm. So what we did is we went out and brought on people like Foster Duncan, who came on very early on, came to us from KKR. David DeLoreal, who came to us from Tower Brook, a big middle market private equity firm. Mark Spender, who's here with us today, moved here from Chicago with his wife and 4 children just this year, so we're very excited to have him. He's very excited about the last 4 days of weather. He can tell you that it's a lot better than where it is in Chicago, and his kids have adjusted very well. We can talk a little bit about the hockey league. They had to figure out how to make hockey work here, but they've done a great job of it. Let's see. Mason Duke just recently joined us from Parthenon Group, a private equity firm out on the West Coast. Julius Bedford has joined us from Rockland, which is a power-focused private equity firm in Houston. Lindsay Mayo was at Shaw, then wound up at Albemarle and has rejoined us. And Brian Poplar, who was in Dallas at Stevens. And so again, a great team here. Obviously, Chris and George having joined us from Shaw, of people who really, we work very well together. We have a lot of fun together, and we take everything that we do in the investments very, very seriously. We have one new associate who's starting in February of this year, so just next month, and then I'm hopefully gonna, if we had another week, I'd be reporting. There's a young man who went to LSU who's at a big middle market firm who we'd offered a job to. The firm gave him a big giant offer to stay, and so we're working, but we're hopeful that that we can get another Louisiana guy back here to be home with us. He's probably been there for 5 years, I guess, and 4 years. And so we got our fingers crossed that we can bring another Louisiana guy back home. But again, a great team. With what we're doing, we feel very, very comfortable with the team that we have and the number of executions at any given time. We've had up to 3 pretty big transactions going at the same time and haven't really felt like, you know, we missed anything with bandwidth. Yeah. On the next slide. So we talked about proprietary deal sourcing. I'm going to have Foster step in. This is a great example of a transaction that wasn't necessarily on our radar, but it was a part of our blueprint was regulatory utility services. So we like to do work for regulated utilities around the country. And Foster and Mark were the two that identified this opportunity and took it forward.
You know, we're really excited about this opportunity, and I think that it's really indicative about how do we approach these businesses, how do we think about them. So this is a company that is involved in coal ash remediation and management. What does that mean? This means that every company that has coal-fired generation has ash ponds, and these guys manage it. What's interesting about this company is that it was part of a process. Houlihan Lokey out of New York was going to run a process. What was attractive to us is that this is something in the regulated utility industry, a service that we like. The part about that that's so attractive is that it's very insensitive to pricing. So what that means, and if you look at my background, I was the number 2 guy at 2 Fortune 500 energy and utility companies. I happen to be living in Louisville, Kentucky. This company is in Louisville, Kentucky. What that means is we kind of knew what that company was going to do in terms of the need for the services, but also the ability for the customer to put that in their rate base. And so that means that they're allowed to pass those costs on. I think what's really attractive about this one is that Houlihan runs the process, we get involved, we talk about what we can bring to the table. Our bringing to the table is not simply writing that check. It's the ability to understand the people's business, so we have the domain knowledge. It's also the ability to really identify great customers. And in doing that, it turns out their biggest customer is Duke Energy. I was number 2 guy at Synergy. We merged it with Duke Energy. The person who is now chairman and CEO of Duke Energy, I hired at Synergy. LG&E in Louisville is another very substantial potential customer. Again, I was the number 2 guy there. We believe between our contacts, our domain knowledge, the ability of the customer to put the cost into rate base, that this is a very attractive deal. We've even heard rumors, we paid around 5 times EBITDA. We've heard rumors that people were looking at this in the 8 times plus. Why did the owner decide to do it? It really goes back to who do you want to do business with? They understood that by some of the other deals we've done. They've understood it by our domain knowledge and our ability to bring in additional customers. So this is a company that's going from like $250 million in revenues to $300, has about $60 million in EBITDA. We think it's just a very, very exciting company and one that really is indicative of the kinds of deals we do within the sectors that we think are really great investments for you all and for us.
Houlihan Lokey, basically what they did is they brought in, I guess it was about 8 parties in a 2-day period to meet with the management team, and so we were one of them. And what the process normally is they go through that management discussion, and then they put out basically something that says, hey, why don't you give us a number on what you guys are willing to pay for the business. At the end of the first day, before they got to the second day, Charles Price, who's the owner, told the banker, will you call Bernhard and those guys and cut the best deal you can, because I feel more confident than anybody I've ever met about where we're taking the business. This is a guy who started this business in 1987 and grew it himself. He's got family members that work there. He's got community members that work there. And he understands that when we tell him that our goal, anytime we're buying a service business, unless Charles tells us differently, our goal is to have 100% retention of every employee and to add employees. Because in a service business, the only way we're growing is if we're adding employees. And so, and that's a little bit different. When these guys speak with, as you can imagine, some New York bankers and other folks, they get very nervous about whether somebody wants to take out the accounting office and take out the HR office and cut jobs. And we really look at it much differently. So, again, big kudos to both Mark and Foster for getting this done in a very short time period. So that meeting that we had was in October. The meeting we had was in October, and we closed on a $300 million transaction by the end of December. And so, you know, lightning fast, where we understand the diligence, we can move quickly, and it works to our benefit when we're able to do that. So I'll talk about our other portfolio companies. As you guys remember, Bernhard is a consolidation of electrical and mechanical and engineering, so basically what we call design, build, mechanical, electrical, plumbing. I'll give you, just to refresh everyone, this is an interesting story because I know Jim was here last year, but his great-grandfather started a business in 1919 called Bernhard Mechanical. When he graduated college in about 1973, he and his brother and his two cousins were getting out at the same time, and his cousin said, his uncle said, we can only take two of you. So they flipped a coin, and Jim was out, so he never had any ownership whatsoever in the family business and went out and basically started Shaw. You know, history it explains itself that he started Shaw and was successful, and now we're doing this. But as we reflected back and we were leaving Shaw, what we recognized is there's a massive opportunity, and it's coming to fruition as we speak in terms of mechanical, electrical, and plumbing. So most of you are familiar with the co-generated power plant here right outside of Tiger Stadium. It's a 20-megawatt power plant that feeds 90% of all the electricity to this campus. And what happens is it's a 20-megawatt power plant that feeds the electricity. But what happens is, since it's on the campus, they're able to use the steam, and the steam generates the chillers that generates the air condition for the entire campus. So as a result of that, it's called combined heat and power. It's highly energy efficient, and the university gets free megawatts of power every single day because of the steam. And so the estimated savings today for LSU is about $12 million annually. On that original investment was only about a $25 million investment. Well, the companies that you see on this board are the ones who designed and built that plant. They also designed and built the plant at University of Arkansas. They also designed and built the plant at Texas A&M. And so we were in the power business, and right outside our eyes with companies we knew were executing this business, and we saw that the industry was changing. And so as we exited, we had the opportunity to knock on the doors of these family-owned businesses we knew and acquire them and give them the story that our idea was to put everybody under one roof and go out and execute this across the nation. And so today, this business does about $400 million in revenue. There's over 1,500 employees today in this particular business across the Southeast, and they're doing very, very well from a profitability standpoint. And so this in particular is an opportunity where we believe that there's a huge opportunity where this company can actually develop some of those types of projects on their own. So where we will go to a university or a hospital and say, we think that we can run these better than you, and we can save you money by doing it. So if you allow us to build it and own it and operate it and sell it back to you over a 30-year period of time, there's a huge amount of savings. And long story short is there's a lot of companies out there, Johnson Controls, Siemens, that try to do these energy savings contracts, and a lot of times they wind up a little convoluted. And what we believe is we come up with a new process by where we protect not only the owner, but also their assets, and can guarantee them savings over a longer period of time, which proves to be very beneficial to us. And one of the reasons we're very excited about this is that this is one of those businesses that is really changing the industry. So to come up, be at the forefront of really changing industry is where you can really provide great return for your investors. And we firmly believe today, more than we probably ever have, that this is what this business will do in the industry.
How much would a power plant like that cost today if you built one for the university? Or let's say, could it run like where we are, where you guys used to be at Shaw, like that whole United Plaza? Is that too big of an area, or does it have to be in a smaller area, or what's the cost of putting one of these?
So two things. One is where you deal with power and combined heat and power, and another is where you're just dealing with air conditioning. So in a lot of circumstances, the power is included, and so power in particular, as you can imagine, when you start trying to sell power to more than just LSU, it gets complicated because of the regulatory regime. So that's the complication around trying to sell power to more than one customer. However, when you just look at looping, basically we call it chill water loops. So when you loop multiple businesses together, at the end of the day, where let's say this building had its own air conditioning unit and the next building had its own air conditioning unit, on and on and on. instead of putting one big air conditioning unit that can handle all of them, because this place is using during the day and at night and sometimes the rec center is only using during the day. In the middle of the night, they're not using where it's getting used here, so it's called mixed use. Long story short is when you make those investments, let's say to handle like the whole complex you're talking about, that'd probably be a $20 million investment, but it's almost a guaranteed net savings of 25% of your electricity savings in year one. And so you're basically looking at a 5-year return, if not quicker than that, because of just the inefficiency there is. And, you know, we talk to developers all the time. The current industry in the United States is that when people build buildings, they don't want to make that big investment up front. But now that the U.S. is finally looking more green, you know, utilities and public service commissions are given incentives to do projects like this, that it's kind of the confluence of a lot of regulatory regime and focus on green climate change is making this a very attractive business. In addition to the fact that this is a business that every day has 1,500 employees and makes great profits. And so it's a double-edged opportunity for us. Second is Epic Piping. So as many of you may know, that in 1987, when Jim left the company he was working for, he left with 2 other guys, and they invested about $50,000 from their 401ks and started a pipe fabrication business in a warehouse that they rented from Jacobs. And the business grew and became the national leader in pipe fabrication. And so we actively looked for opportunities to acquire in this particular business. There were 3 or 4 businesses around the country that we had an interest in potentially making an acquisition. And after doing all the analysis, we basically sat back and said, you know what? The best way to invest in this business is do what we did before, is start a greenfield. And so we put together a management team, and we found a location in San Marcos, Texas. It's about 300,000 square feet of manufacturing and fabrication space. We leased that facility, and we retrofitted it for pipe fabrication. That facility's been up and running for just over, I guess, 18 months. And then secondly, here in Livingston, Louisiana, and Frost, Louisiana, we just completed about 5 months ago a $42 million fabrication facility that now employs approximately 250 people and is fully up and running fabricating piping. In addition to that, we rented 450,000 square feet in UAE. There's a particular client in the UAE in the Middle East who's going to be building a refinery in Kuwait, a brand new grassroots refinery, and wanted us to go to the Middle East with them to help them fabricate all the piping for that particular facility. So a good example of where, with respect to, we're mostly North American focused, but if a good client like a Shell or a Bechtel or an Exxon wants to bring us international for a specific project, we'll normally go, and that's a good example of the reason that we did that. So first year in operation was last year, and a full year of operation. The business did about $80 million in revenue. Unfortunately, we're sad to say, we'd never like to lose money, but in the first year of a startup business, we didn't quite break even, but we were very close. And this next year looks to be very, very good. So again, being in at cost without having to pay a big multiple for an existing business, with systems we don't like and a location we don't like, with labor we maybe weren't excited about. We have a first-in-class team, and a differentiator for us in this particular business is we will be the clear leaders in technology. We were always the leaders in technology at Shaw with respect to pipe fabrication, and with new technologies that are out right now, robotics and laser welding in particular, we are highly, highly confident that we will be the low-cost provider in an environment where we can make good returns, again, for the investment that we made. Because by investing in technology, whereas our competitors maybe don't have the balance sheet or aren't willing to invest in that technology, we're really gaining a significant amount of market share because of that. I talked about Brown & Root, and I'll have Mark give you an overview of ATC.
Am I not here? Microphone good? Okay. All right. Good afternoon. So I'll just give a little bit of background on ATC. I think it, again, is representative of a type of sort of differentiated approach we've been able to take on our investments. The business itself is an environmental services provider. It's doing consulting and field services work for a number of different industries, from commercial construction and banks doing financial diligence to retail petroleum, and now with some of the businesses we've acquired, also servicing refineries and some chemical facilities as well. But it fit into this kind of blueprint strategy Jeff was talking about, where I think we identified some themes that we wanted to invest behind. I think the two biggest in this particular example were that environmental regulation was going to continue to increase, and therefore growth in spending by corporates to sort of solve those environmental regulatory needs. And the second thesis being that across the environmental services landscape, really there's kind of a barbell approach. There was a whole bunch of small kind of private owner, maybe $30 million, $40 million revenue firms, and then there was a handful of large environmental services firms inside the larger engineering and construction firms, and there was really nothing in between the two. And so we set out to try to create kind of this middle of the road approach to build a maybe $500 or $800 million revenue environmental services firm. And that was sort of the blueprint that this fit into. We were, I think, thrilled to have the opportunity to start as large as we did with the ATC platform. And it was a combination of kind of opportunity and our pursuit of opportunity that I think landed this one kind of back home here in Louisiana. It was a business that was owned historically by a large private equity institution by the name of Cerberus, and they had owned it for about 10 years. In 2013, they sold it to Cardno, which was an Australian publicly traded, predominantly mining services institution, and they never really integrated the business well. They had owned it for a few years. The business itself, being a people business, had started to taper off because the employees weren't happy and it was poorly managed. Cardno itself had come under sort of a hostile investor that was making some noise and wanted them to change the business, the Cardno business as a whole, make some divestitures such as this. And we were quick to get in and have a discussion with Cardno and say, we can give you a quick solution. We're not going to be, to Jeff's point, the highest dollar on the street, but in this particular circumstance, what Cardno needed was speed. And so we were able to get in there and sort of mobilize quickly and do all of our work in about 6 or 7 weeks, which for a firm of our type is incredibly quick. Most firms would take 5 months to do that work. And so we delivered them what they really needed, which is speed, and we were able to cut a very good deal for ourselves. Net of sort of the excess working capital and excess cash in the business, we paid just over 4 times for this business coming in. And then since then, we've been successful in adding on 3 new platforms between about $2 million EBITDA and about $6 million EBITDA each. So the business today, this year, will do over $20 million in EBITDA, and I think we have sort of a weighted entry point of about 5 times. This is a business that would easily sell today for 7 or 8 times EBITDA, but we're actually in the process of making some additional acquisitions and looking forward for more growth. So we're taking a bit of a breather right now because 3 deals for a management team like this is a lot for a year, and there's kind of a digestion period that needs to take place to make sure the systems are all integrated and that we're sort of pursuing the synergies that exist between these institutions. But we've added on an air consulting business, which is big in the downstream, in the refineries and in the chemical facilities. We've added on a leak detection services business, which again services a lot of the chemical facilities. And then we've added on a business called Environmental Compliance Services, which does a lot of the core ATC environmental work, particularly around retail petroleum, but it filled in a geographic need for ATC where they had some national customers that we weren't able to serve up in the Northeast due to sort of a miss in our footprint there. So it filled in that nicely. So I think we're thrilled with the way the business is going now. We're excited to have had a chance to do 4 proprietary deals on this platform already. And after a bit of a breather here, we'll be back out in pursuit of some additional acquisitions that, again, will kind of build the platform from either a service perspective or a geographic perspective.
Thank you, Mark. Yeah. So today, within the portfolio, 5 companies, and we have over 10,000 employees. So, pretty quick in terms of the growth. If we think about, historically having managed company with 40,000 employees, we feel very comfortable with that portfolio. Obviously, these are totally independent in terms of their strategies and even how they attack the market of where these companies sit today. One of the things we are very proud of is that today we currently have 3,000 employees in Louisiana. If we think back about the peak, we had only had 5,500 employees at the peak of what we had done within Shaw within the company. So having 3,000 today here is something that excites us a lot. We live here, and We like to work with people that we know and people that we trust, and we have a couple of wonderful management teams that run these businesses. At the same time, this is a diverse portfolio. As we mentioned, Char, these guys are out of Louisville, Kentucky. They do a little bit of work for Clico, but for the most part, 90% of their work is, around the country in North Carolina and in Ohio and Louisville, et cetera. So, again, a very diverse portfolio of what we have today, and very excited about what we've built in a short period of time. If we have a few minutes, I'll talk a little bit about kind of where we see just the general market, starting with kind of globally. I think what we saw with, we think about these things a lot. We have at our office, and as a matter of fact, we invite any of you to come by and visit with us anytime. I know many of you are in town, but we have a room we call the Think Room. And so it's got a little round table, and it's got a big whiteboard, and it's got a couple of sofas and chairs. And so we think it's important to take a break. A lot of times while we were at the Shaw Group, we didn't have time to kind of sit back and think about where things are really moving. We thought about them a lot, but we were always moving too. So now we take a little bit more time to say, okay, where's the world going? Well, where's the world going today? We have a huge surge in populism and globalism, and anti-globalism, really. I mean, if you think about what happened with Brexit, what happened with the Arab Spring, just I guess it was 2 years ago, and with our current president, it's a symbol against establishments everywhere. So what does that mean? We don't have all the answers, but we know that it's a trend that may be with us for a while. What does it mean for the U.S.? It probably means that as we look at major infrastructure spending that the president's going to do, that we're not going to have a lot of imports. So we import a lot of steel from China, from India, from all over the place. So it could, drive construction costs higher. So as we think about doing piping, as we think about projects, as we think about procuring materials for things, we need to have in mind, with respect to everything that we do, that the likelihood is that, there's going to be a huge focus on America first. I mean, everybody heard it, but it's real. It means that there's going to be policies in place where things are going to be bought here, and that's going to change the opportunities we have to get the materials we need. Obviously, there's going to be focus on immigration and, the talk about the wall. What does that mean to us in our businesses? It means it may put some stress on the labor market. So as we look for workers, and there's, a massive amount of folks who are here legally, who work on all of our jobs all over the country, that, that's going to create some tension. So we think a lot about what that means for escalation within our wages and where things are going to change within these independent companies. We are very excited about the opportunity to build more infrastructure. We're huge believers in the fact that, this country just absolutely needs it. It needs it not only so that people can do carpool, but it means that, we need to fix this bridge, because recently we dealt with a trucking company that is not a huge trucking company, but they're losing about $1 million a year in terms of just their drivers being stuck coming from Port Allen and trying to get to Ascension Parish. And that's unbelievable. If you multiply that out, it's a big impact on this particular community, and that's all over the country. So we get to watch it because, we're downtown and we look out the window and we have to see it every day at about 2:30. And so spending on infrastructure, water, wastewater, bridges, that's going to be a huge trend, and that's something that we're going to take advantage of. And so as we think about future investments, we think about those opportunities, and when we think about, just to kind of let you insight on a little bit of how we think about our blueprint strategy. Okay, there's going to be a lot of roads and bridges built. Well, there's going to be investors who want to own those roads and bridges and do public-private partnerships and finance. But what we want to do is we just want to be the picks and shovels, right? We want to start with the geotech. So geotechnical engineering is the first thing that ever happens when there's big major infrastructure in terms of checking on the ground and how the ground's doing and what it can handle. And so as we think about potentially more investment that we've had in the last 30 years in infrastructure, and knowing that's going to be the first thing out of the gate, that's what we're actively pursuing right now, is looking at opportunities in big markets where we know there's there's pent-up demand and big needs for the type of infrastructure that the president's talking about, and looking for firms that are well-positioned for that type of opportunity. Road construction companies is something that, we believe, again, once the infrastructure spending starts, that it takes a long time for it to slow down. So it's going to be a massive amount of road transportation infrastructure work around the country. We continue to like environmental. We talked about energy efficiency with two of our companies. Our environmental company does a little bit. The Bernhard company does a lot. But that is a huge trend within the country where utilities need more help to help them find ways to reduce their footprint of electricity. And so it's a big trend. It's something we've been involved in for a while. So it's another area that we're currently thinking about, as well as lots of others, as you can imagine. But that just kind of gives you a sense of kind of from the macro all the way down to the micro where we currently see the market and how we think about it and how we make sure that we're protecting our risk on the downside and understanding what those risks are. And we're also looking for opportunities to obviously do much better than what the current market is giving you in terms of the investments we're making. So with that, I think it's been a mouthful, but I'd like to open it up for any questions.
So what's next after Shara? It's like you filled your bucket. What's next?
Yeah, so we have room. We're looking at another particular. When we found Chara, we were actively looking in regulated utility services, and so we didn't exactly have a focus on basically coal ash residuals, but we came across it and it was intriguing enough that we went after it. But we still like utility services. So if you think about somebody like Entergy. I'm talking about anybody there's people out in this neighborhood right now who are inspecting utility poles for Entergy to, people who are doing some engineering around transmission distribution. Transmission distribution is probably the biggest area of investment for regulated utilities right now because they're not really building new power plants. And so what they're doing is they always want to deploy capital. The utilities, if they're not deploying capital, they're not increasing their return. So is basically how the regulatory system works. So the one area that they're able to do that right now is transmission distribution. And so that's an area where we're specifically looking for opportunities and have a team of people who've come on to work with us to run that company. And I don't know, we probably have a group of 50 companies that we're kind of reaching out to right now. So.
This is a specific question about your business, but there's a nuclear power plant owned by Entergy that powers a lot of New York City. I just heard this on NPR. And the governor really wants to close that down. How do you close down one plant that provides?
It means that their electricity bills are going to go up. So so that's called, it's Indian Point, right? Indian Point? Yeah, Indian Point. Right. They haven't shut it down yet, but there's always been a big push for shutting that one in particular down. Another one that was just recently, I say recently, it's been shut down for probably 18 months, is in San Onofre, California, which is right near San Diego. It's unbelievable. It's on one of the most beautiful pieces of property you could ever imagine, right on a military base. And the story goes that Richard Nixon landed his helicopter at the military base, and on his way out, it was when the government, we were building a lot of nuclear plants, and he turned to the guy and he said, y'all need to build one right there. And sure enough, there's one right there. But they wound up shutting it down 18 months ago, and what's interesting is there's not enough electricity without it to serve the area, which is San Diego, basically. And so the basic utility rates of the ratepayers, right now, the government is basically subsidizing it, but in like another year, all their rates going to go up 20, 30%. And people are going to go crazy, but it's kind of the regulatory environment where the certain political folks are making decisions to shut these things down, where in our opinion, it doesn't make any economic sense. Decommissioning of nuclear plants is going to be a big business. Yeah, so the decommissioning is very complex. There's basically 2 landfills that exist within the United States that are able to take that nuclear fuel. One is owned by a company called Energy Solutions that's backed by a private equity firm called Energy Capital Partners. The other is called WTS in Texas. Energy Capital Partners with Energy Solutions tried to buy WTS. Thank God, just as a citizen, the government said that's antitrust, which it absolutely is. And so we've been kind of having some discussions about potentially talking to those folks, because if you have the site, which is basically, and not to make anybody nervous about owning a nuclear landfill, but the government basically totally backstops anything that could happen with something called the Price-Anderson Act. So you're able to really limit your liability because the government knows that at some point somebody's got to deal with this stuff, and so you have certain protections, and it's a lucrative business to help deal with it. So that's another area that we'll be looking at, is decommissioning those plants.
Any other questions? If not, great, that was fantastic. It's always good to have a large part of our investments that are actually making a nice return, and is also in Louisiana, in that order. So I want to thank those guys for providing this for us, and thanks for coming by. Appreciate it.
Well, he mentioned something about returning. You know, we're at the end of the year. Well, we're past the end of the year, but we're just in the finalizing everything. And since we're at home, I'll just share with you that I think everybody will be excited. Our returns are going to be above what the average returns are for funds of our vintage, and pretty well above it. So we obviously are very excited about that, and are going to be looking to turn some of those around to get the real returns back to you soon.
Perfect. We'll always take the money.
Thank you.
All right, thank you.